CFA Level 1 Program Curriculum Reading 9 Probability Concepts Learning Outcomes. Mastery of the candidate should be able to A. Define a random variable, an outcome, an event, mutually exclusive events, and exhaustive events. B. State 2. Defining properties of probabilities and distinguish among empirical, subjective, and a priori probabilities. State the probabilities of an event in terms of odds for and against the event. Distinguish between conditional, unconditional, conditional probabilities. Explain multiplication, addition, and total probability rules. Calculate and interpret the joint probabilities of two events, the probability that at least one of two events will occur, given that probability of each of the joint probabilities of two events, and 3, a joint probability of any number of independent events. G. Distinguish between dependent and independent events. Calculate and interpret an unconditional probability using the total probability rules. Explain the use of conditional expectations in investment applications. Explain the use of tree diagrams to represent an investment problem. Calculate and interpret covariance and correlation. Calculate and interpret the expected values of variation and standard deviation of a random variable and a return on portfolio. M. Calculate and interpret covariance given a joint probability function. N. Calculate and interpret an updated probability using Bayes' formula, and lastly, identify most appropriate methods to solve a particular counting problem, and solve counting problems using factorial combinations and permutation concepts. Introduction. All investment decisions are made in an environment of risk. The tools that allows us to make decisions with consistency and logic is in this setting comes under the heading of probability. The reading presents the essential probability tools needed to frame and address many real-world problems involving risk. We illustrate how these tools apply to such issues as predicting investment managers' performance, forecasting financial variables, and pricing bonds so that they fairly compensate bondholders for default risk. Our focus is practical. We explore in detail the concepts that are most important to investment research and practice. One such concept is the independence, and as it relates to the predictability of returns and financial variables. Another is expectations, as analysts continually look to the future in their analysis and decisions. Analysts and investors must also cope with variability. We present variance or dispersion around expectations as a risk concept important in investment. The reader will acquire specific skills in using portfolio expected returns and variance, the basic tools of probability, including expected values and variance, and set out in Section 2. Of this reading. Section 3 introduces covariance and correlation, measures of relatedness between random quantiles, and the principles of calculating portfolio expected returns and variance. Two topic ends the reading. Bayes' formula and outcomes counting. Bayes' formula is a procedure for updating beliefs and based on new information in several areas, including a widely used option pricing model. The calculation of probabilities involves defining and counting outcomes. The reading ends with a discussion of principles and shortcuts for counting. 2. Probability, expected value, and variance. The probability concepts and tools necessary for most of an analyst's work are relatively few and simple, but requires thought to apply. This section presents the essentials for working with probability, expectations, and variance, drawing on examples from equity and fixed income analysis and investors' concerns center on returns. The returns on the risky assets is an example of random variable. A quantity whose outcomes or possible values are uncertain. For example, a portfolio may have a return objective of 10% a year. The portfolio manager's focus at the moment may be on the likelihood of earning a return that is less than 10% over the next year. 10% is the particular value or outcomes of the random variables. Portfolio returns. Although we may be concerned about a single outcome frequency, our interest may be in a set of outcomes. The concept of event covers both definition of event. An event is a specified set of outcomes. We may specify an event to be single outcomes. For example, the portfolio earns a return of 10%. We use italics to highlight statements that defines events. We can capture the portfolio manager's concerns by defining an event as the portfolio earns a return below 10%. The second event referring as it does to all possible returns greater or equal to negative 100%, the worst possible return, but loss less than 10%, contains a finite number of outcomes. To save words, it is common to use a capital letter in italics to represent a defined event. We could define A as the portfolio earns a return of 10% and B as the portfolio earns a return below 10%. To return to the portfolio manager's concern, how likely is it that the portfolio will earn a return below 10%? The answer to this question is a probability, a number between 0 and 1 that measures the chance that a stated event will occur if the probability of 0.4 or 40% that a portfolio earns a return between 10% below 10%. There is a 40% chance of that event happening. If that event is impossible, it has a probability of 0. If an event is certain to happen, it has the probability of 1. If an event is impossible or sure thing or 100% probability of happening, it is not random at all. Because in order to be random, it has to be either binomial or polynomial, which means has outcomes. Two or more outcomes. So 0 and 1 brackets all the possible values of a probability. Probability has two properties, which together constitute its definition of probability. Two defining properties of probability are as follows. 1. The probability of any event E is the number between 0 and 1, where the probability of event happening is between 0 and 1. The sum of the probabilities of any set of mutually exclusive and exhaustive events equals 1. P follows the perithesis stands for the probability of the event of perithesis, as in PE for the probability of event E. We could also think of P as the rule or function that assigns numerical values to event consistent with probabilities 1 and 2. In an above definition, the term mutually exclusive means that only one event can occur at a time. Exhaustive means that the event covers all possible outcomes. The event A, the portfolio earns a return of 10%, and B, the portfolio earns a return below 10%, are mutually exclusive because A and B cannot both occur at the same time. For example, a return of 8.1% means that B has occurred and A has not occurred. Although events A and B are mutually exclusive, they are not exhaustive because they do not cover outcomes such as the returns of 11%. Suppose we define a third event, event C. The portfolio earns a return above 10%. Clearly, when the portfolio earns a return above 10%, then we call it the probability of event C occurring. The probability of C is a number between 0 and 1. And probability of A plus probability of B plus probability of C is equal to 1. The most basic kind of mutually exclusive and exhaustive event is the set of all the distinct probabilities outcomes of a random variable. If we know both the set and assignment of probabilities to those outcomes, the probability distribution of the random variable, we have a complete description of the random variable, and we can assign a probability to any event that might describe. The probability of any event is the sum of the probabilities of the distinct outcome included in the definition of the event. Suppose the event of interest is D, is equal to the portfolio earns a return above the risk-free rate. We know that probability distribution of a portfolio returns. Assume the risk-free rate is 4% to calculate P probability D, the probability of D. We would sum the probabilities of outcomes and satisfy the definition of the event. That is, we would sum the probabilities of portfolios returns greater than 4%. Earlier, to illustrate a concept, we assumed the probability of 0.4 for a portfolio earning less than 10%. Without justifying the particular assumptions, We also talked about using a probability distribution of outcomes to calculate the probability of events without explaining how a probability distribution might be estimated. Making actual financial decisions using inaccurate probabilities may have grave consequences. How, in practice, do we estimate probabilities? This topic is the field of study itself, but there is 3 broad approaches to estimating probabilities in investments. We often estimate the probabilities of an event as the relative frequency of occurrence based on historical data. The method produces an empirical probability. For example, Ferranti, 2013, reports that his sample of 1,927 yearly observations of non-financial SET, or the stock exchange of Thailand, firms during the years of 2002 to 2010 was 1,382, was divided by the paying firms of 545. When non-dividend paying firms, the empirical probability of a Thai firm paying a dividend is thus 1,382 divided by 1,972, which is 0.72, approximately. We will point out empirical probabilities in several places as they appear in this reading. Relationships must be stable through times of empirical probabilities to be accurate. We cannot calculate an empirical probability of an event not in historical record, or a reliable empirical probability for a very rare event. There are cases then in which we may adjust an empirical probability to account for perceptions of changing relationships. In other cases, we have no empirical probability to use at all. We may also use a personal assessment of probability without reference to any particular data. Each of these 3 types of probability is a subjective probability, one drawing on personal or subjective judgment. Subjective probabilities are of great importance in investments. Investors are making buy and sell decisions that determines asset prices, often draws on subjective probabilities. Subjective probabilities appears in various places in this reading, notably in the discussion of Bayes' formula. In a more narrow range of well-defined problems, we could sometimes deduce probabilities by reasoning about the problem. The resulting probability is the priori probability, one based on local analysis rather than the observations or personal judgment. We will use this type of probability in example 6. The counting methods we discuss later are particularly important in calculating the priori probabilities because the priori and empirical probabilities generally do not vary from person to person. That is often grouped as objective probabilities. In business and elsewhere, we often encounter probabilities stated in terms in odds. For instance, the odd of E, or the odd against E, for example, as of November 2013 analyst fiscal year 2014 of EPS forecast for JetBlue Airways ranged from 0.55 to 0.69. Suppose an analyst asserts that the odds of a company betting the highest estimate of 0.69 are 1 to 7. Suppose a second analyst argues that the odds of against the happenings are 15 to 1. What do those statements imply about the probability of a company's EPS beating the highest estimate? We interpret probability stated in terms of odds as follows. Probability stated as odds given a probability P, given a probability PE. Suppose for event E to occur, PE is divided by 1 minus PE. The odds of E are the probabilities of E divided by the 1 minus the probability of E, given odds for E of A to B. The implied probability of E is A divided by A plus B. In this example, the statement that the odds of the company's EPS for fiscal year 2014 beating 0.69 and 1 to 7 means that the speaker believes the probability of the event 1 divided by 1 plus 7 is 1 divided by 8 is 0.125. Odds against E equals 1 minus PE divided by PE. The reciprocal of odds for E given odds against E of A to B, the implied probability of E is B divided by A plus B. The statement that the odds against the company's EPS for fiscal year 2014 beating 0.69 and 15 to 1 is consistent with a belief that the probability of the event is 1 divided by 1 plus 15 or 1 over 16 or 0.0625. To further explain odds for an event, if the probability of E is 1 out of 8, the odds for E are 1 out of 8 divided by 7 out of 8 is equal to around 1 out of 8 divided by 8 out of 7 is equal to 1 divided by 7, which is 1 to 7. For each occurrence of E, we expect 7 cases of non-occurrence out of 8 cases in total. Therefore, we expect E to happen once, and the probability of E is 1 out of 8. In wagering, it is common to speak in terms of the odds against something, as in statement 2 for odds of 15 to 1 against E. An implied probability of E is 1 out of 16. A $1 wager on E if successful, returns 15. If profits plus 1 stacked in the wager, we can calculate the bet's anticipated profits as follows. The win, if probable, is 15. The loss, you lose your current principal, which is $1. The anticipated profit is therefore 0. Weighting each of the wager's 2 outcomes by respective probability and outcomes. If the odds or the probabilities are accurate, the anticipated profit to the bet is 0. Okay. Example 1, profiting from inconsistent probabilities. You are examining the common stock of 2 companies in the same industry in which an important antitrust decision will be announced next week. The first company, Smithco Corporation, will benefit from a government decision that there is no antitrust obstacles related to a merger in which it is involved. You believe that Smithco's share price reflects a 0.85 probability of such a decision. A second company, Selbert Corporation, will equally benefit from a go-ahead ruling. Surprisingly, you believe Selbert stock reflect only a 0.5 probability of a favorable decision. Assuming your analysis is correct, what investment strategy will profit from this pricing discrepancy? Consider the logical possibilities. One is that the probability of 0.5 reflected in Seibert's share price is accurate in this case. Selbert is fairly valued, but Smithco's is overvalued as its current share price is overestimates the probability of a go-ahead decision. The second possibility is that the probability of 0.85 is accurate. In that case, Smithco's shares are fairly valued, but Selbert shares which build in a lower probability of a favorable decision are undervalued. You may diagram the situation as shown in table 1. The 0.5 probability column shows that Selbert shares are better valued than the Smithco shares. Selbert shares are a better value if a 0.85 probability is accurate. Thus, Smithco shares are overvalued relative to Selbert shares. Your investment actions depend on your confidence in the analysis and on any investment constraints you face, such as constraints on selling stock shorts. A conservative strategy would be to buy Selbert shares to reduce or eliminate any current positions in Smithco. The most aggressive strategy is to short Smithco stock relatively overvalued and simultaneously buy the stock of Selbert relatively undervalued. This strategy is known as pair arbitrage trade. Pairs arbitrage trade. Trade is a trade in 2 closely related stocks involve a short sell of one and a purchase of another. The prices of Smithco and Selbert shares reflect the probabilities that are not consistent according to one of the most important probabilities results for investments, the Dutch book theorem. Inconsistent probabilities create profit opportunities. In our example, investors buy by their buys and sell decisions to exploit the inconsistent probabilities should eliminate the profit opportunity and inconsistencies. To understand the meaning of probability in investment context, we need to distinguish between two types of probability: unconditional and unconditional. Unconditional and conditional. Both unconditional and conditional probabilities satisfy the definition of probabilities stated earlier, but they are calculated or estimated differently and have different interpretations. They provide answers to different questions. The probability in answers to the straightforward question, what is the probability of event A, is an unconditional probability denoted as P given A. P, the probability of A occurring. Unconditional probability is also frequently referred to as marginal probability. Suppose the question is, what is the probability that stock earns a return above the risk-free rate? Event A, the answer is an unconditional probability that can be viewed as the ratio of two quantities. The numerator is the sum of the probabilities of stock returns above the risk-free rate. Suppose the sum of 0.7, the denominator of 1, the sum of the probabilities of all possible returns. The answer to the question, probability of A is 0.7. Contrast to the question, what is the probability of A, with the question, what is the probability of A given that B has occurred? The probability is answer to this last question is a conditional probability denoted as A given B. Read probability of A given B. Suppose we want to know the probability of the stock earns a return above the risk-free rate. Event A, given the stock earns a positive return. Event B, with the words given that, we are restricting returns to the larger than 0%. A new element is in contrast to the question that brought forth the unconditional probability. The conditional probability is calculated as the ratio of two quantities. The numerator is the sum of the probabilities of stock returns above the risk-free rate. In this particular case, the numerator is the same as it was the unconditional case, which we gave as 0.7. The denominator, however, changes from 1 to the sum of the probabilities for all the outcomes, aka returns above 0%. Suppose the number of 0.8 a larger number than 0.7 because returns between 0 and a risk-free rate have some positive probability of occurring. Then probability of A given B is 0.875. If we observe that the stock earns a positive returns, the probability of returns above the risk-free rate is greater than the unconditional probability, which is the probability of events given given no other information. The result is intuitive. The result is intuitive to review. Unconditional probability is a probability of event without any restrictions. It might even be thought of as a standalone probability. A conditional probability, in contrast, is a probability of an event given that another event has occurred. In discussing approaches to calculating probabilities, we gave an empirical estimate of the probability that a chance in individuals and a dividend increases. The probability was an unconditional probability. Given additional information on company characteristics, could an investor refine that estimate? Investors continually seek an information edge that would help improve their forecasts. In mathematical terms, they are attempting to frame their view of the future using probability conditioned on relevant information or events. Investors do not ignore useful information. They adjust their probabilities to reflect it. Thus, the concept of conditional probability, which we analyze in more detail below, as well as related concepts discussed further on, are extremely important in investment analysis and financial markets. To state an exact definition of conditional probability, we first need to introduce the concept of joint probability. Suppose we ask the question, what is the probability of both A and B happening? The answer of this question is a joint probability denoted as AB, given read as probability of A and B. If we think of the probability of if we think of the probability of A and the probability of B as sets built of the outcomes of one or more random variables, the joint probability of A and B is the sum of the probabilities of the outcomes they have in common. For example, consider two events. The stock earns a return above the risk-free rate of A, and the stock earns a positive return B. The outcomes of A are contained within the subset of the outcomes of B. So probability of A and B equals probability of A. We can now state a formal definition of conditional probability that provides a formula for calculating it. Definition of conditional probability: the conditional probability of A given B has occurred is equal to the joint probability of A and B divided by the probability of B, assuming not equal to 0. Probability of A given B is equal to the probability of AB divided by the probability of B, given that B is not 0. Sometimes we know that conditional probability of A given B, we want to know the joint possibility, the joint probability of a probability A and B. We could obtain the joint probability from following the multiplication rule of probabilities with equation 1 rearranged. A multiplication rule of probabilities, the joint probability of A and B can be expressed as probability of A and B equals probability of A given probability of B multiplied by probability of B. Okay, I'm gonna end today's reading at this part at page 495, and I'm going to continue the future reading in our future segments. So I hope to see you guys in the next one, and see you guys there. Goodbye. Okay, conditional probabilities and predictability of mutual fund performance. Vidal Garcia, 2013, examines whether historical performances predict future performance for a sample of mutual funds that include 1,050 actively managed equity funds in 6 European countries during the periods of 1988 through 2010. Funds were classified into 9 investment styles based on a combination of investment focus, growth, blend, and value. The fund's market capitalization, small, mid, and large cap. One approach Vidal Garcia used involved calculating each fund's annual benchmark adjusted return by subtracting a benchmark return from the annual return of the fund. MSCI, or the Morgan Stanley Capital International Style Index, were used as benchmarks for each style of fund in each country. Funds were classified as winners or losers for each of the 2 consecutive years. The top 50% of funds by benchmark adjusted return for a given year were labeled winners. The bottom 50% were labeled losers. An accept form of results were studied in 135 French fund classified as large value funds. Given in table 2, it shows the percentage of those funds that were winners in 2 consecutive years, winners in 1 year, and then losers in the next year, losers and then winners, and then losers in both years. The winner entry, for example, shows that 65.5% of the first year winner funds were also winners in the second year. Note that the 4 entries in the table can be viewed as conditional probabilities. Based on the data in Table 2, answer the following questions. State the 4 events needed to define the 4 conditional probabilities. State the 4 entries of the tables as conditional probabilities using form P. This event, given that event equals number. Are the conditional probabilities in Part 2 empirical, a priori, or subjective probabilities? Using information in the table calculates the probability of the event a fund is a loser in both years 1 and year 2. Note that because 50% of funds are categorized as losers in each year, the unconditional probability that a fund is labeled a loser in either year is 0.5. Solution to 1. The 4 events needed to define the conditional probabilities are as follows. Fund 1 is a year 1 winner. Fund is a year 1 loser. Fund is a year 2 loser. And fund is a year 2 winner. Solution to 2. From row 1, the probability of the fund is a year 2 winner, given the fund is a year 1 winner, is 0.655. The probability that fund 2 is a loser given that fund year is a winner is 0.345. From row 2, and once again it's this. Solution to 3. The probabilities are calculated from datum. So they are empirical probabilities. A solution to 4, the estimated probability is 0.423, with A, the event that a fund is a year 2 loser, and B, the event that a fund is a year 1 loser. AB is the event that the fund is a loser in both year 1 and year 2. From table 2, the probability of A given B is 0.845. The probability of B is 0.5. Thus, you could get this. Equation 2 states that the joint probability of A and B equal the probability of A given B times the probability of B, because probability A and B is probability B and A. The expression probability A and B equals probability B and A, which is equal to probability B given A divided by A, or multiplied by A, is equivalent to equation 2. When we have two events, A and B, that we are interested in, we often want to know the probability that either A or B occurs. Here is the word or is inclusive, meaning that either A or B occurs, or both A and B occurs. Put another way, the probability of A or B is the probability that at least one of the two events occurs. Such probabilities are calculated using addition rule for probabilities. Addition rule for probabilities. Given events A and B, the probability that A or B occurs, or both occurs, is equal to the probability that A occurs plus the probability that B occurs minus the probability that both A and B occurs. So P, given probability A or B, is equal to probability A plus probability B minus probability A and B. If we think of individual probabilities of A and B as sets built of outcomes of one or more random variables, the first step in calculating the probability of A or B is the sum of the probabilities of the outcomes in A to obtain P probability of A. If A and B shares any outcomes, then we know when we now added probability of B to probability of A, we will count twice the probabilities of those shared outcomes. So we add probability A and the quantity probability B minus probability A and B, which is the probability of outcomes in B net of the probability of any outcomes already counted when we computed probability of A. Figure 1 illustrates the process. We avoid double counting the outcomes in the intersections of A and B by subtracting probability A and B. And as an example of calculation, if probability A equals 0.5, probability B equals 0.4, and probability A and B is 0.2, then probability A or B equals 0.5 plus 0.4 minus 0.2, which gives us 0.7. Only if the two events A and B were mutually exclusive, so that probability A and B equals 0, would it be correct to state that probability A or B equals probability A plus probability B. So this is what it means. If A is this and B is this, if we add them together, we'll be counting the middle part, A plus B, twice, right? Because we'll be counting when we add A, we'll also be counting 1 plus B. So in order to calculate this area of A plus B, we have to do A plus B minus A and B. The next example shows how much useful information can be obtained using a few probability rules presented at this point. Let me go get water really fast. Alright, example 3, probability of a limit order executing. You have 2 buy limit orders outstanding on the same stock. A limit order to buy stock at a stated price is an order to buy at that lower the price or lower a number of vendors, including an interest service that you use, supplies the estimated probability that a limit order will be filled within a stated time horizon. Given the current stock price and the price limits, one buy order or order 1 was placed at the price limit of $10. The probability that it will execute within 1 hour is 0.35. The second buy order 2 was placed at a price limit of 9.75. It has 0.25 probability of executing within the same 1 hour time frame. What is the probability of either order 1 or order 2 will execute? What is the probability that order 2 executes given that order 1 executes? Solution to 1, the probability is 0.35. The 2 probabilities that are given are P, order 1 executes equals 0.35, and P, order 2 executes equals 0.25. Note that if order 2 executes, it is certain that order 1 also executes because the price must pass $10 to reach 9.75. Thus, probability of order 1 executing given probability that order 2 executes is equal to 1, and the probability that order 1 executes and order 2 executes is equal to the probability of order 1 executes given that order 2 executes, multiplied by probability of order 2 executing, which is 1 multiplied by 0.25, which is 0.25. To answer the question, we use the addition rule for probabilities, where probability of order 1 executes or order 2 executes equals the probability of order 1 executes plus the probability of order 2 executes minus the overlapping, okay, the order and order 1 and order 2 both occurring. Note that the outcomes for which order 2 executes are a subset of the outcomes for which order 1 executes. After you count the probability that order 1 executes, you have counted the probability of the outcomes for which order 2 also executes. Therefore, the answer to the question is the probability that order 1 executes is 0.35. Solution to 2. If the first order executes, the probability that the second order executes is 0.714. In the solution to part 1, you find that the probability of order 1 executes and order 2 executes is equal to 0.25. An equivalent way to state the joint probability is useful here. Probability of order 1 executes and order 2 executes is 0.25. The probability of order 2 executing given probability of order 1 executing multiplied by probability of order 1 executing, which also gives us 0.25 as well. Okay. Of great interest to investment analysts are the concepts of independence and dependence. These concepts bear on such basic investment questions as which financial variables are useful for investment analysis, whether asset returns can be predicted, and whether superior investment managers can be selected based on their past records. 2 events are independent if the occurrence of one event does not affect the probability of occurrence of the other event. Definition of independent events. 2 events A and B are independent if and only if probability of A given B is equal to probability A, or equivalently probability B given A is equal to probability B. When 2 events are not independent, they are dependent. The probability of occurrence of one is related to the occurrence of the other. If we are trying to forecast one event information about a dependent event may be useful, but information about an independent event will not be useful. When 2 events are independent, the multiplication rule for probabilities Equation 2 simplifies because probability of A given B is the equation for probability of A. Multiplication rule for independent events. When two events are independent, the joint probability of A and B are equal, and the product of the individual probabilities of A and B, which is probability of A and B is equal to probability A multiplied by probability B. Therefore, if we are interested in two independent events with probabilities of 0.75 and 0.5, respectively, the probability that both will occur is 0.375 or equal to 0.75 multiplied by 50. The multiplication rule for independent events generalizes to more than two events. For example, if A, B, and C are independent events, then probability of A, B, and C is equal to probability of A multiplied by probability of B multiplied by probability of C. Example 4, Bank Corp's earnings per share. As part of your work as a banking industry analyst, you build models for forecasting earnings per share of a bank you cover. Today, you are studying Bank Corp. A historical record shows that in 55% of recent quarters, Bank Corp's EPS has increased sequentially, and in 45% of quarters, EPS has decreased or remained unchanged sequentially. At the point in your analysis, you are assuming that changes in sequential EPSs are independent. Earnings per share for Q 2014, the second quarter of 2014, that is the second quarter of 2014, were larger than EPS for Q1 2014. What is the probability that 3Q 2014 EPS will be larger than 2Q 2014 EPS? Also known as a positive change in sequential EPS. What is the probability that EPS decreases or remains unchanged in the next two quarters? Solution to 1. Under the assumption of independence, the probability that Q3 for 2014 EPS will be larger than Q2 2014 EPS is the unconditional probability of positive change, 0.55. 0.55. The fact that the second quarter of 2014 EPS was larger than the first quarter of 2014 EPS is not useful information, as the next change in EPS is independent of the prior change. Solution to 2, the probability is 0.2025, which is equal to 0.45 multiplied by 0.45. The following example illustrates how difficult it is to satisfy a set of independent criteria, even when each criteria by itself is not necessarily stringent. Example 5, screening stocks for investments. You have developed a stock screen, a set of criteria for selecting stocks. Your investment universe, the set of securities from which you make your choices, is the Russell 1000 index, an index of the 1000 largest capitalization U.S. equities. Your criteria captures different aspects of the selection problem. You believe that the criteria are independent of each other to a close approximation. So here is the table. How many stocks do you expect to pass your screen? Only 23 stocks out of 1,000 pass through your screen. If you define 5 events, the stock passes the first valuation criteria. The stock passes the second valuation criteria. The stock passes the analyst coverage criteria. The company passes the portfolio, the profitability criteria. The company passes the financial strength criteria. So say events A, B, C, D, and E respectively, then the probability that a stock will pass all 5 criteria under independence is this. Although only one of the 5 criteria is even moderately strict, the strictest lets 25% of stocks through. The probability that a stock can pass all 5 is only 0.02331, or about 2%, the size of the list of candidates' investments in out of 2% out of 1,000 is around 23 stocks. An area of intense interest to investment managers and their clients is whether records of past performance are useful in identifying repeat winners or losers. The following examples shows how the issue relates to the concept of independence. Example 6, conditional probabilities and predictabilities of manual fund performance. The purpose of Vidal Garcia's 2013 study introduced in example 2 was to address the question of repeated European mutual funds winners and losers. If a state of the fund is a winner or a loser in one year, its independence of whether it is a winner in the next year. The practical value of performance ranking is questionable. Using the four evidence, define example 2 as building blocks. We can define the following events to address the issue of predictability for mutual fund performance. So here's what it looks like. In part 4 of example 2, you calculate that P, the probability of fund in a year 2's loser and fund 1 year 1 loser is 0.423. If a ranking in 1 year is independent of the ranking in the next year, what do you expect P, the probability of the fund in year 2 loser and a fund 1 to be loser, to be? Interpret the empirical probability of 0.423 by the multiplication rule of independent events. P, funds in year 2 losers and funds in year 1 losers. The probability of funds in a year 2 loser multiplied by fund 1 losers in year 1. Because 50% of funds are characterized as losers in each year, the unconditional probability that a fund is labeled a loser in either year is 0.5. Thus, the probability of a fund is a loser in year 2 multiplied by the probability that fund is a year 1 loser is equal to 0.5 multiplied by 0.5, which is 0.25. If the state of a fund as a loser in 1 year is independent of whether it is a loser in the prior year, we conclude that probability of fund is a year 2 loser and fund is a year 1 loser is 0.25. This probability is the priori because it is obtained from reasoning about the problem. You can also reason that the 4 events described above define categories and that the fund are randomly assigned to the 4 categories. There is a 1 out of 4 probability of a fund in a year 1 loser and funds in a year 2 loser. If the classification in year 1 and year 2 are independent, then the assignment of funds and categories will not be random. The empirical probability of 0.423 is above 0.25. It is apparent predictability, the results of chance test conducted by Vidal Garcia indicates a less than 1% chance of observing the table data in year 1 and year 2 rankings were independent. In investments, the question of whether one event or characteristic provides information about another event or characteristic arises in both time series settings through time and cross-sectional settings among units at a given point in time. Example 4 and 6 examines independence in a time series settings. Example 5 illustrates independence in a cross-sectional setting. Independence/dependence relationships are often explored in both settings using regression analysis, a technique we discuss in a later reading. In many practical problems, we logically analyze a problem as follows. We formulate scenarios that we think affect the likelihood of an event that interests us. We can estimate the probability of the event given the scenario. When the scenario or the conditional event are mutually exclusive and exhaustive, no possible outcomes are left out. We can then analyze the event using the total probability rule. This rule explains the unconditional probability of the event in terms of probabilities conditional on the scenarios. The total probability rule is stated below for 2 cases. Equation 5 gives the simplest case in which we have 2 scenarios. One new notion is introduced if we have an event or scenario S, the event non-S, so-called complement S, is written as SC. Note that PS, the probability of S plus probability of SC is equal to 1. So when I learn probability, I use S and S prime with like a little dot, like a tilde on the top. But now it's C. But that's, it's finance. It's kind of different than when I learned statistics back in university. As either S or S or not S must occur. Equation 6 states that rules for the general case of n mutually exclusive and exhaustive events or scenarios. The total probability rule. So here's the total probability rule. So A is equal to AS plus ASC. Makes sense? And this also makes sense. Okay. Where S1, S2, all the way to Sn are mutually exclusive and exhaustive scenarios or events. Equation 6 states the following. The probability of any event, the probability of A, can be expressed as a weighted average of the probabilities of the event given scenarios. Terms such as A given scenario 1 are weights. The weights applied to these conditional probabilities are the respective probabilities of the scenario. Terms such as probability of S1 multiplying probability of A given S1 and a scenario must be mutually exclusive and exhaustive. Among other applications, this rule is needed to understand Bayes' formula, which we discuss later in this reading. Or in the reading, not this exact reading. In the next example, we use the total probability rule to develop a consistent set of views about Bank Corp's earnings per share. Bank Corp's earnings per share. You are continuing your investigation into whether you can predict the direction of changes in Bank Corp's quarterly EPS. You define 4 events. A is the change in sequential EPS is positive next quarter. It has the probability of 0.55. A prime or AC, I'm going to say A prime because it's easier. So A prime, which is not equal to prime, which is not equal to A. All values not equaling to A. Is the change in sequential EPS is 0 or negative next quarter. So once again, if we look at A plus A prime, we'll get negative. We'll get 55 plus 45, which is 100. S represents the change in sequential EPS is positive in the prior quarter, and SC is the change in sequential EPS is 0 or negative in the prior quarter. On inspecting the data, you observe some persistence in EPS changes. Increases tend to be followed by increases, and decreases by decreases. The first probability estimate you develop is P. The probability of change in sequence of the EPS is positive next quarter. Given that the change in the sequential EPS is 0 or negative in the prior quarter, is this, which is 0.4, the most recent quarter. The most recent quarter's EPS is 2Q in 2014 is announced, and the changes is the positive sequential change in event S. You are interested in forecasting EPS for third quarter 2014. Write the statement and probability notion. The probability that the change in sequential EPS is positive next quarter, given that the change in sequential EPS is positive the quarter prior. Calculate the probability in part 1. Calculate the probability that is consistent with the other probabilities or beliefs. Solution to 1 in probability notion. The statement is written as probability of A given probability of S. Solution to 2, the probability is this much. That is the change in sequential EPS is positive for third quarter 2014, given the positive change in sequential EPS in second quarter 2014. As shown on the following page, according to equation 5, a probability of A is this. The values of probabilities needed to be calculated as probability of A given S are already known. Probability of A equals 0.55, probability of S equals 0.55, and A prime S prime equals that. So we could get 0.55 equals this. Yes. In this reading on statistical concepts and market returns, we discussed the concepts of a weighted average or weighted means. The example highlighted in the reading was the portfolio returns is a weighted average of the returns on the individual assets in the portfolio, where the weight applied to each asset's return in the fraction of the portfolios invested in the assets, the total probability rule, which is a rule for stating an unconditional probability in terms of conditional probabilities, is also a weighted average. In that formula, probabilities of scenarios are used as weights. Part of the definition of weighted average is that the weights sum to 1. The probabilities of mutually exclusive and mutually exhaustive events do sum to 1. This is part of the definition of probability. The next weighted average we discussed, the expected value of a random variable, also uses probabilities as weights. The expected value of a random variable is an essential quantitative concept in investments. Investors continually make use of expected values in estimating the rewards of alternative investments and forecasting EPS and other corporate finance variables and ratios, and in assessing any other factors that may affect your financial position. The expected value of a random variable is defined as follows. Definition of expected value. The expected value of a random variable is the probability weighted average of the possible outcomes of the random variable for a random variable x. The expected value of x is denoted EX. Expected values, for example, expected stock returns looks either to the future as a forecast or to the true value of the mean, the population mean discussed in the reading on statistical concepts and market returns. We should distinguish expected returns from the concept of historical or sample mean. The sample mean also summarized in a single number of central value. However, the sample mean presents a central value for a particular set of observations as an equally weighted average of those observations. To summarize, the contrast is forecast versus historical or population versus sample. Example 8, Bank Corp's earnings per share. You continue with your analysis of Bank Corp's EPS. Earnings per share stands for EPS. In table 3, you have recorded a probability distribution for Bank Corp's EPS for the central fiscal year. Here's the table. What is the expected value of Bank Corp's EPS for the central fiscal year? Following the definition of expected returns, list each outcomes weighted by its probabilities and sum the terms. Why would we sum the terms? That's something I don't get. Okay. EPS is equal to 1.5 multiplied by 2.6, 4.5, 4.45 multiplied by 2.45 is literally probabilities multiplied by expected earnings per share. Okay, and then you just multiply all of them together and add it up, and you get the expected earnings per share of 2.3405. The expected value of EPS is 2.34. An equation that summarizes your calculation in example 8 is this. I absolutely hate summation marks. It's like, yes, we get it. I know how to calculate. Everybody knows, but it's just annoying to look at. And it just gives me flashbacks back to high school. Or example xi is one of n's possible outcomes of the random variable x to the power of 8. The expected values is our forecast because we are discussing random quantiles. We cannot count on individual forecasts being realized, although we hope that on average forecast will be accurate. It is important as a result to measure the risk we face. Variance and standard deviation measures the dispersion of outcomes around the expected values of forecasts. Definitions of variance. The variance of a random variable is the expected value, the probability subtracted by weighted average of squared deviations from a random variable's expected value. So this is the standard deviation squared, which is variance, is equal. So remember how standard deviation squared is variance, or no, variance squared is standard deviation, or one of the other. Variance is the number greater than or equal to 0 because it is the sum of squared terms. If variance is 0, there is no dispersion or risk. The outcomes is certain and the quantity x is not random at all. Variance greater than 0 indicates dispersion of outcomes. Increasing variance indicates increasing dispersion. All else equals, or ceteris paribus when it comes to economics. Variance of x is a quantity in the squared unit of x. For example, if a random variable is returned and percent variance of returns is a unit of percent squared. Standard deviation is easier to interpret than variance as it is the same unit as the random variable. If the random variable is returns in percent, standard deviation is returns is the unit of percent. The following example, when the variance of returns is stated as a percent or amount of money, to conserve space, the reading may suppress showing the unit squared. Note that when the variance of returns is stated as a decimals, the complication of dealing with units of percent squared does not arise. Definition of standard deviation. Standard deviation is the positive square root of the variance. The best way to become familiar with these concepts is to work through an example. Bancorp's earnings per share, part 4. In example 8, you calculated the expected values for Bancorp's earnings per share as 2.34, which is your forecast. Now you want to measure the dispersion around your forecast. Table 4 shows the view of the probability distribution of EPS for the current fiscal year. So this is the current fiscal year. What are the variance and standard deviation of Bancorp's EPS for the current fiscal year? The order of calculation is always expected value, the variance, then standard deviation. Expected values has already been calculated following the definition of variance above. Calculate the deviation of each outcome from the mean or expected value. Square each deviation, weighted or multiply each square deviation by its probability of occurrence, and then sum these terms. So the standard deviation squared of earnings per share is equal to this. Yeah. So an equation that summarizes your calculation for variance in example 9 is variance of x is equal to the probability of x1 plus or multiplied by the probability of x1 minus ex to the power of 2. So the probability of x to the power of 2 plus 2 values 2 to the n, and if you to the 3 to the 4 to the 5, and all the way to the n for the last term, and then you will use a summation to represent that. When xi is one of n possible outcomes of the random variables x, in investments, we make use of any relevant information available in making our forecasts. When we refine our expectations or forecasts, we are typically making adjustments based on new information or events. In the case, we are using conditional expected returns. The expected value of a random variable x given an event or scenario S is denoted as EX given S. Suppose the random variable x can take on any one of n distinct outcomes, x1, x2, all the way to xn. These outcomes from a set of mutually exclusive and exhaustive events. The expected value of x conditional on S is the first outcome of of x1 times the probability of the first outcome given S1, given S, probability S, f x1 given that. We will illustrate the equation shortly. Parallel and total probability rules stating unconditional probabilities in terms of conditional probabilities. There's a principle for stating unconditional expected values in terms of conditional expected values, the principle of the total probability rule for expected value. Yeah. Here's a tree diagram. Here's conditional variances. Here's some more examples and more tree diagrams. Default risk. Face value. Yeah, okay. So I do hope these readings are helpful, and I hope to see you guys in the next part. We'll be continue reading 9, part 3 of the CFA Level 1 program curriculum. Okay, I'll see you guys there. Goodbye. Continue reading, part 3, portfolio expected returns and variance of returns model. Portfolio theory makes frequent use of the idea that investment opportunities can be elevated using expected returns as a measure of reward and variance of return as a measure of risk. The calculations and interpretations of portfolio expected returns and variance of returns are fundamental skills. In this section, we will develop an understanding of portfolio expected returns and variance of returns. Portfolio returns is determined by the return on the individual holdings. As a result, the calculations of portfolio variance as a function of the individual asset returns is more complex than the variance calculation illustrated in the previous sections. We work with an example of a portfolio that is 50% invested in S&P 500 index fund, 20% invested in the U.S. long-term corporate bond fund, and 25% invested in the index of the MSCI EAFE index, representing equity market in Europe, Australasia, and the Far East. Table 5 shows these weights. Okay, so just 50%, 25, 25. We first addressed the calculations of the expected returns on the portfolio in the previous section. We defined the expected value of a random variable as the probability weighted average of the possible outcomes. Portfolio returns we know is a weighted average of the returns on the securities in the portfolio. Similarly, the expected returns on the portfolio is a weighted average of the expected returns on the securities in the portfolio using exactly the same weights. When we have estimated the expected returns on the individual securities, we immediately have portfolio expected returns. This convenient fact follows from the properties of expected value. Properties of expected value, let Wi be any constant and Ri be a random variable. The expected value of a constant times a random variable equals the constant times the expected value of the random variable. So this makes sense. You can multiply the expected value and you will get the same expected values. The expected value of a weighted sum of random variables equals the weighted sum of the expected values using the same weights. So it has a distributive law. Suppose we have a random variable with a given expected value. If we multiply each outcome by 2, for example, the random variable's expected value is multiplied by 2 as well. This is the meaning of part 1. The second statement is the rule that directly leads to the expression of portfolio expected returns. A portfolio with n securities is defined by its portfolio weights, W1, W2, W2, all the way to Wn, which sums to 1. So portfolio returns, Rp is Rp equals W1, R1, plus W2, R2, plus W all the way to Wn, Rn. The weight and the returns. We could state the following principles. Calculation of portfolio expected returns. Given a portfolio with n securities, the expected returns of the portfolio is weighted average of the expected returns on a component of the securities. So this is just intuitive. You should know this even without knowing the formula. We calculate the expected returns on the portfolio of 11% by doing this. So 50% is the weight of the S&P 500, and the S&P 500 returns is 13%. So we multiply them, add it by the 25% from the U.S. long-term corporate bonds, multiplied by 6, and then 15 multiplied by 25. That gives us and added all of these weighted asset classes together, and you get 11.675%. That's a decent return on your investment. In the previous section, we studied variance as a measure of dispersion of outcomes around the expected value. Here, we are interested in portfolio variance of returns as a measure of investment risk, letting RP stand for the return on the portfolio variance of of standard deviation squared, RP equals this. According to equation 8, how do we implement this definition? And just reading on statistical concepts and market returns, we learn how to calculate a historical or sample variance based on a sample of returns. Now we are considering variance in a forward-looking sense. We will use information about the individual assets in the portfolio to obtain portfolio variance of a return. To avoid clutter in notation, we write ERP for ERP. Okay, so expected returns of RP. We need to the concept of convariance. Definition of covariance. Given two random variables, Ri and Rj, the covariance between Ri and Rj is the Ri subtracted by the expected returns of Ri multiplied by Rj subtracted by the expected returns of Rj. Alternative notions of the standard deviation of Ri and Rj as the standard deviation of Ij. Okay. Equation 14 states that the covariance between two random variables is the probability weighted average of the cross product of each random variable's deviation from its own expected value. We will return to discuss covariance after we establish the need for the concept, working on the definition of variance we find. So what you do is you break these apart into the 1, 2, 3s, the W1 R1 all the way to W3 R3. And then from this, you using the distributive law, you multiply the E into the equation. So using equation 13, and then by doing this, we could group them together by dragging the W's out. So W1 and W1 could drag it out, and the square remains the same. So after you drag it out, you reorganize it, and then you get this. But because it is squared, you multiply it by itself once because it's squared by twice. And so you literally just break them apart with the distributive law. So that's long. Doing multiplication, just break it up. And recalling the W1, so you recall the W terms into the front, and these are like the constants. And by that, you'll get this. Okay, so basic algebra, you should be able to follow along with it. The last steps follows from the definitions of variance and covariance. From the italicized covariance terms in equation 15, we use the fact that the orders of variables in covariance does not matter. Take a sip of my coffee. Okay, so yeah. Using the most compact way to state equation 15 is the standard deviation squared is equal to RP. Two summations, because you sum this first and then you add all of them up and then you sum that again. So you use sigma. You use sigma once and to expand this, and you use sigma twice to add up all of these summed variables. The double summation sign says Si equals 1 and let J run from 1 to 3. Then set I to equal 2 and let J run from 1 to 3. Next, set I equals 3 and let I is equal to 1 to 3. Finally, the ninth term, the expression generates the same ELISAs for the portfolios of any size n to, yeah. We see from equation 15 that individual variance of returns constitute a part, but not all of portfolio variance. The 3 variances are actually outnumbered by the 6 covariance terms of the diagonal. For stated assets, the ratio is 1 to 2 or 50%. If the asset class, if there are 20 assets, there are 20 variance terms. 2020 divided by 20 is 380 off diagonal covariance terms. The ratio of variance terms of off-diagonal covariance terms is less than 6 to 100, which is 6%. Of a first observation, then is that a number of the holding increases, covariance becomes increasingly important, all else equal. What exactly is the effect of covariance on portfolio variance? The covariance terms captures how the co-movement returns affect the portfolio variance. For example, consider 2 stock. One tends to have high returns relatively to its expected returns, when the other has low returns relative to its expected returns. The returns on one stock tend to offset the returns on the other stock, lowering the variability of variance of returns on the portfolio. Like variance, the units of covariance are hard to interpret, and we will introduce more intuitive concepts shortly. Meanwhile, from the definition of covariance, we can establish 2 essential observations about covariance. This is basically a summary of this section. We can interpret the sign of covariance as follow. Covariance of returns is negative if when the returns on one asset is above its expected values, the return on other assets tend to be below its expected values. An average inverse relationship between returns. Covariance of returns is 0 if returns on the assets are unrelated. A covariance of returns is positive when the returns on both assets tend to be on the same side, above or below their expected values at the same time. An average position relationship between returns. The covariance is of a random variable with itself, or own covariance is its own variance of this. A complete list of the covariance constitutes all the statistical data needed to compute portfolio variance of return. Covariance are often presented in a square format called a covariance matrix. Table 7 summarizes the inputs for portfolio expected returns and variance of returns. Table 7, input to portfolio expected returns and variance. So here's what it looks like. Here's what it is. With 3 assets, the covariance matrix of 3 squared equals 3 multiplied by 3, which equals 9 entries. But is the customary to treat the diagonal terms, the variance, separately from the off-diagonal terms? These diagonal terms are bolded in Table 7. The distinction is natural, as security variance is a single variable concept, so there are 9 minus 3, which is 6 variances, including variance. But because the covariance of these equals covariance of B and C, because they, first of all, the order doesn't matter. Second of all, they are interchangeable. That's why they're like that. The covariance matrix below the dialogue is the mirror image of the covariance matrix above the diagonal. As a result, there are only 6 out of 2 or 3 distinct covariance terms to estimate in general. For n securities, there are n multiplied by n minus 1 divided by 2 distinctive covariance to estimate, and n variances to estimate. Suppose we have the covariance matrix shown in Table 8. We will be working in returns stated as percent, and the table entries are in units of percent squared or percent squared. The term 18% squared, we do squared because so that the negative don't affect how much it is, or the negative signs don't affect the numerical value. So we're only looking at the numerical value. So they'll become like this, respectively stating the decimals correctly working in percents and decimals lead to identical answers. So Table 9 covariance matrix, the S&P 500. Once again, this is the same thing. Taking equation 15 and grouping variance terms together produces the following. So literally plugging into equation 17 gives us the numerical value of 195.875. The variance is 185.875. Standard deviation is 14%. To summarize, the portfolio has an expected annual returns of 11.75% and the standard deviation of returns of 14%. Let us look at the first 3 terms of the calculations above. Their sum, 100 plus 5.0625 plus 27.5625 is equal to this. Is the contributions to the individual variance to portfolio variance of a return on 3 assets where independent covariance would be 0, and the standard deviation of portfolio returns would be 11.52% as compared to 14% below. The portfolio would have less risk. Suppose the covariance terms was negative. The negative number will be added to this. So the portfolio variance and risk will be even smaller. At the same time, we have not changed expected returns for the same expected period. Portfolio returns, the portfolio has less risk. This risk reduction is a diversification benefit, meaning a risk reduction benefit from holding a portfolio of assets. The diversification benefit increases with decreasing covariance. The observations is a key insight of modern portfolio theory. It is even more intuitively stated when we use the concept of correlation. Then we could say that as security returns are not perfectly positively correlated, diversification benefits are possible. Furthermore, the smaller the correlation between security returns, the greater the cost of not diversifying in terms of risk reduction benefit foregone. all else equal. Definition of correlation. The correlation between two random variables Ri and Rj are defined as this covariance of those standard divided by the standard deviation of them. Alternative notions are covariance Ri, Rj, or P, Ij. Frequently, a covariance is substituted out using the relationship of this. The deviation indicates in the definition makes correlation a pure number with one without a unit of measurement. It places bonds on its largest and smallest possible values. Using the above definition, we can state a correlation matrix from data in the covariance matrix alone. Table 9 shows the correlation matrix. Okay. For example, the correlation between long-term bonds and MSCI EAFE or this stock index is 38. From table 8, the standard deviation of long-term bonds has a return of 9%. The MSCI return is around 21%. For the diagonal term of table 8, the correlation or the probability of return on long-term bonds given or comma return on EATF is 38 divided by 9% multiplied by 21, which is 0.201, rounded to 0.2, which is around 20%. The correlation of the S&P 500 with itself equals 1. The calculation of its own covariance divided by the standard deviation squared. Properties of correlation. Correlation is a number between -1 and 1. It's between -1 and 1. The two random variables of x and y. So this is the properties of correlation formula. A correlation of 0 or an uncorrelated variable indicates an absence of any linear relationship between the variables. So the closer they are to 0, the more the closer they are to be linear, the greater the relationship. Increasing positive correlation indicates an increasingly strong positive linear relationship up to 1, with indicating a perfect linear relationship. Increasingly negative correlation indicates an increasingly negative correlation or inverse linear relationship down to -1, which indicates perfect inverse linear relationship. Okay, example 12. Example 12. Portfolio expected returns and variance on returns. You have a portfolio of two mutual funds, A and B, 75% invested in A, as shown in table 10. Okay, you have two investments, A and B. 75% in A, and then I would expect 15% in B. Okay, something like that. And then yeah. Calculate the expected returns of the portfolio. Calculate the correlation matrix of this problem. Carry out the answer to two decimals. Compute portfolio standard deviations. The return solution to 1, you literally multiply by 2 and add them all up together. So you multiply by 2, right? You multiply the returns. You multiply the portfolio weighting by the returns. Portfolio weighting by returns. Add them up together, you get 18%. Solution to 2. The standard deviation of RA is 25%. The standard deviation of RB is 14%. There are one distinct covariance of thus the distinct correlation of this. Or 0.34. Table 11 shows the correlation matrix. Table 11 correlation matrix. So literally that's what it looks like. Diagonal terms are always equal to 1 in a correlation matrix if it has perfect correlation. A solution to 3. Once again, you plug it into the previous formulas and you'll get around a 20.22% return. How do we estimate returns, correlation, and covariance? Frequently, we use forecasts on the basis of historical covariance, or use the methods based on historical return data as a market model registration. We can also calculate covariance using joint probability function or a random variable. If that can be estimated, the joint probability function of two random variables, x and y, denoted as probability of x and y, gives the probability of a joint covariance of values. X and y, for example, are probability of 3, probability of 2. If the probability of x equals 3 and y equals 2, suppose that the joint probability function of a return of bankrupt stock is RA, and the returns of new bank stock is RB, then the simple structure given table 12 will look something like this. The expected returns of Bank Corp stock is 25% multiplied by portfolio weightings. You add them all up together is 14%. The expected returns of new bank, this is another bank stock, is around 15%. The joint probability function above might reflect the analyst based on whether banking industry conditions are good, average, or poor. Table 13 presents the calculation of covariance. Table 13, covariance calculations, banking industry conditions, good, average, poor. Deviation Bank Corp, deviation New Bank Corp. So how much product deviation, and this is the weighted product. The first and second columns of numbers shows respectively the deviation of bankrupt and new bank returns of the mean and expected values. The next column shows the product of the deviation. For example, for good industry conditions, this would be around 55 multiplied by 0.2. The probability of 11. The calculations of average are poor. Are average and poor for banking conditions following the same pattern. Summing the probability weighted products, we find the covariance of A and B to be 16. The formula of computing the covariance between random variables of A and B are given in this formula 18. The formula tells us to sum all possible deviation cross products weighted by the appropriate joint probability. In the example we just worked, as table 12 shows, only 3 joint probabilities are non-zero. Therefore, in computing the covariance of returns, in this case, we need to consider only 3 cross products. The covariance of A and B using the formula will give us around 16. One ding that this reading has been one ding of this reading has been independence. 2 random variables are independent where every possible pairs of events. One event corresponding to a value of X and another event corresponding to a value of Y are independent events. When 2 random variables are independent, the joint probability function simplifies. Definition of independence for random variables: 2 random variables X and Y are independent if and only if probability of XY equals probability of X multiplied by probability of Y. For example, given independence probability 2 equal to probability of 3 multiplied by probability of 2. We multiply the individual probabilities to get the joint probabilities of the independence is a stronger probability than uncorrelatedness, because correlation addresses only linear relationships. The following conditions holds for independent random variables, and therefore also holds uncorrelated random variables. Multiplication rules for expected values of product and uncorrelated random variables. The expected value of product of uncorrelated variables is the product of their expected value. So this is quite intuitive. If you know the expected values of X and Y, you can multiply by 2. Are given that they're and also these 2 are uncorrelated. That means they're independent. They're not related to each other. Many financial variables. An example of uncorrelated would be how Amazon stock is in the S&P 500. So if the S&P 500 increases by 10%, what is the probability that Amazon also increases by 10%? So this is a correlation, because Amazon stock contributes to the S&P 500 index. So uncorrelated thing maybe the Foxconn stock in Taiwan being uncorrelated to the S&P 500, since these 2 are uncorrelated individual events. Many financial variables such as revenue, price, time, quantity are the product of random quantities. When applicable, the above rule simplifies calculating expected values of a product of random variables. Topics and probability. In the remainder of this reading, we discuss 2 topics that can be important in solving investment problems. We start with Bayes' formula for what probability theory has to say about learning from experience, and then we move to discussion about shortcuts and principles for accounting. 4.1 Bayes' formula. When we make decisions involving investments, we often start with a viewpoint based on our own experience and knowledge. These viewpoints may be changed or confirmed by new knowledge and observation. Bayes' formula is a rational method for adjusting our viewpoints as we confirm new information. Bayes' formula and related concepts have been applied to many business investment decision-making contexts, including the elevation of mutual fund performances. Bayes' formula makes use of equation 6, the total probability rule, to review the rule expressed the probability of an event as a weighted average of the probabilities of the event. Given a set of scenarios, Bayes' formula works in reverse. More precisely, it reverses the given that information. Bayes' formula uses the occurrence of the event to infer the probability of the scenario generating it. For that reason, Bayes' formula is sometimes called inverse probability in many applications, including one illustrating the use of this section, an individual updating his beliefs concerning the causes that may have produced a new observation. Bayes' formula, given a set of prior probabilities for an event of interest, If you receive new information, the rule for updating your probability of the event is updated probability of event given the new information equals probability of new information given event divided by unconditional probability of new information in brackets multiplied by prior to probability of events. In probability notions, this formula can be written concisely as the probability of event given information equals the probability of information given an event divided by information multiplied by the probability of event. To illustrate Bell's formula, we work through an investment example that can be adapted to any actual problem. Suppose you are an investor in the stock of DriveMed Incorporated. Positive earnings surprises relatives to consensus EPS estimate often results in positive stock returns, and negative surprise often have an opposite effect. DriveMed is preparing to release last quarter's EPS results, and you are interested in which of these three events happens. Last quarter's EPS exceeds the consensus EPS estimate, or last quarter's EPS exactly met the consensus EPS estimate, or last quarter's EPS fell short of the consensus EPS or the earning per share estimate. This list of the alternatives is manually exclusive or exhaustive. On the basis of your own research, you write down the following prior probabilities or prior for shorts concerning those three events: the probability of exceeding, the probability of meeting, and the probability of falling short, having 0.45, 30%, and 25% respectively. These probabilities are prior in the sense that they reflect only what you know now before the arrival of any new information. The next day, DriveMed announces that the expanding factory capacity in Singapore and Ireland to meet increasing sales demand. You assess this new information. The decision to expand capacity relates not only to current demand, but probably also to prior quarters sales demand. You know that sales demand is positively related to EPS, so now it appears more likely that your last quarter's EPS will exceed the consensus. The question you have is, in light of the new information, what is the updated probability that the prior quarter's EPS exceeds the consensus estimate? Bell's formula provides a rational method for accomplishing this update. We could abbreviate the new information as DriveMed expands. The first step in applying Bell's formula to calculating the probability of the new information here is given as this. Excuse me. Conditional probability is an observation here as the DriveMed expenditure are sometimes referred to likelihood. Again, likelihood are required for updates of the probability. Next, we combine these conditional probabilities or likelihood with your prior probability to get an unconditional probability to DriveMed expanding. So this is you plug into a method, you get 41%. This is equation 6, the total probability rule in action. Now you can answer your question by applying the Bell's formula. Plug it into the formula, get 0.823171. Prior to DriveMed's announcement, you dot the probability that DriveMed will beat census expectations will around 45%. On the basis of your interpretation of the announcement, you update the probability to 82.3%. This updated probability is called the posterior probability because it reflects or comes after the new information. The Bell's calculations takes the prior probability, which is 45%, and multiplies it by the ratio a first term on the right hand side of the equation signs without considering conditional ons or anything else. Therefore, the probability is unconditional. The numerator is the probability of DriveMed expands if the last quarter's EPS actually exceeds the consensus estimates. This last probability is larger than the unconditional probability in the denominator, so the ratio is 0.383 roughly. Is greater than 1. As a result, your updated posterior probability is larger than your prior probability. Thus, the ratio reflects the impact of the new information on your prior beliefs. Okay, example 13. Inferring whether DriveMed's EPS met consensus EPS, you are still an investor in DriveMed stock. To review on the givens, your prior probabilities of P of exceeding success is this. meeting consensus is dirty, and short of consensus is 0.25. You have now the following conditions of probabilities listed out right here. Recall that your updated probability of last quarter is this, so you literally just plug it in. You get your you use the Bell's formula. You plug it in, you get this. Once again, you want to calculate with the new information what happens. With the new information, plug it in, you get this. Quite straightforward solution to 3. To sum the 3 updates of the probabilities, you do probability of extending consensus given the expands, and you multiply, add them up together, and you get 1. Solution to 4. Okay. Makes sense. 4.2, principles of counting. The first step in addressing a question often involves determining the different logical possibilities. We may also want to know the number of ways that each of these possibilities can happen. In the back of our minds is often a question about probability. How likely is it that I will observe this particular probability? Recall, records of success and failures are an example. When we evaluate a market times record, one well-known evaluation method using counting methods presented in this section, an important investment model, the binomial option pricing model, incorporates the combination formula that we will cover shortly. We can also use the methods in this section to calculate what we call a priori probability in section 2. We can assume that the possible outcomes of a random variable are equally likely. The probability of an event equals the number of possible outcomes, variable for the event divided by the total number of outcomes. And counting enumerations, counting the outcomes by one, if a course of the most basic revenue, what we discussed in the section of the shortcuts of the principles. Without these shortcuts and principles, counting the number can be very difficult and prone to error. So multiplying rules of counting. If one task can be done with n1, and a second task given the first can be done in n2 ways, then the third task given the first 2 tasks can be done in n3, which give us k tasks. The number could be represented as n1, n2, n3 to n of k. Suppose that we have 3 steps in the investment decision process. The first step can be done in 2 ways, the second step in 4 ways, and a third step in 3 ways. Following these multiplication rules, there are 24 ways in which we will carry out these 3 steps. Another illustration of the assignments of members of a group to an equal number of positions. For example, suppose that we want to assign 3 security analysts to cover 3 different industries. In how many ways can we assign? Can assignment be the first? The first analyst may be assigned in 3 different ways. The second, then 2 industry remains. The second analyst could be assigned in 2 different ways. Then 1 industry remains, and the third in the last ways. And there could be only way. The total number of different assignments are equal to 3 to 1, which equals to 6. The compact notions of multiplications we have just prior to 3, 3 of exclamation mark is read as 3 factorial. When we have n analysts, the number of ways we can assign them to n task would be n factorial, or n factorial. By convention, 0 factorial is 1, but that's just a rule. Just as anything to the 0th power is 1, similar to that. To review, in this application, we repeatedly carry out operation here, job assignments and a group. The next type of counting problems can be called the labeling problem. We want to give each object in a group a label to place it in a category. Relatively important when we use spreadsheets to represent it. The following example illustrates the type of problems. Mutual fund guides ranked 18 bonds mutually funds by total remains for the year of 2014. The guide also assessed each fund one of 5 risk labels: high risk for funds, average risk for funds, and above average risk for funds, average risk 3 funds, below average risk 4 funds, and low risk 3 funds, which gives us 18. All of these funds are accounted for. How many different ways can we take 18 mutual funds and label 4 of them high risk, 4 above, 4 average, 4 below, and 4 low? Then each of these labels. The average, the answer is close to 13 billion. We could label any 18 funds high risk, the funds the first slot, then any 17 remaining funds, and then any 16 remaining funds, and then 15 remaining funds. Then we can label any 14 remaining funds above average risk and any 13 remaining funds, and so forth. There are 18 possible sequences. However, order to assignment within a category does not matter. For example, whether a fund occupies the first or third slot of the 4 fund labeled high risk, the fund has the same labels of high risk. Thus, there are 4 factorials, making this Okay, I'm sorry. I think there was just a technical difficulties. Anyways, I'll continue reading from this paragraph right here. The answer is close to 13 billion. We are labeled any 18 funds highest risk, the first slot, and any 17 remaining funds and remain third. Okay. However, order of assignment within a category does not matter. For example, whether a fund occupies the first or third slot of the 4 funds labeled high risk, the fund has the same label of high risk. Thus, there are 4 factorials. Making the same arguments of the same categories, the total are 343 is equivalent to the sequence regarding of how it is organized. Okay, multinomial formulas, the general formula for labeling problems. The number of ways n objects can be labeled with k different labels, with n1 of the given first type, n2 of the second type, and so on, with n1 plus n2 plus n3 all the way to n is given by this. The multinomial formula with 2 different labels of k2 is especially important. The special case is called the combination of formulas. A combination is a listing in which the orders of the list items does not matter. The state of the combination formula in a traditional manner, but no new concepts are involved. Using the notation of the formula below, the number of objects with the first label r equals n is given as this. Here's the formula, combination of formula. The binomial formula looks like this. If you label R objects as belonging to the group, the remaining objects as does not belong to the group, whatever the group of interest, the combination formulas tell us how many ways we could select a group of size R. We could illustrate the formula with the binomial options of pricing models. The model describes the movement of underlying assets as a series of movement, pricing up U or pricing down D, for example. 2 sequences of 5 movements contains 3 up moves, such as UUUDD or UDUUD, resulting in same final stock prices, at least for an option with a payoff dependency on the final stock price. The number 2, but not in order to move up the sequential matters. How many sequences are in the 5 moves belonging to the group with the up 3 moves? The answer is 10. Calculating using the distribution formula, choose 5 out of 3. Which gives us the formula, the factorial of 5 and 3 is 10 ways. Useful facts can be illustrated as follows. Here's a few interesting facts. Suppose, we also have the permutation formula, which is just like that. Okay. What are the summaries for reading 9? Let's go over the summaries. In this reading, we have discussed the essential concepts of tools of probability. We have applied probability, expected values, and variance to a range of investment problems. A random variable is a quantity whose outcome is uncertain. Probability is a number between 1 and 0, or 0 and 1, that describes the chance of a stated event occurring. An event is a specific set of outcomes or a random variable. Mutually exclusive events can occur only at one at a time. Exhaustive events occurs or contains all possible outcomes. The 2 defining properties of probability are: first, probability of the probability of event happening is between 0 and 1, when probability of E or PE is denoted as the event of E. Secondly, that the sum of the probability is the sum of the probability of any set of mutually exclusive and exhaustive events equals 1. The probability estimates from a data as a relative frequency of occurrence is an empirical probability. A probability drawing on personal or subjective judgment is a subjective probability. A probability obtained based on logical analysis is a priori probability. A probability of an event E, probability of E, can be stated as odds. E equals probability of E divided by 1 minus probability of E, or the odds against E are equal to 1 minus probability of E divided by probability of E. Probabilities that are inconsistent create profit opportunities, according to the Dutch book theorem. Probability of events cannot be conditioned on another event is unconditional probability. Unconditional probability of event A is denoted as probability A. Unconditional probabilities are also called marginal probabilities. A probability of an event given conditional or conditioned on another event is a conditional probability. The probability of condition A and B is noted as probability of A given B. The probability of both A and B occurring, and the joint probability of A and B is called probability AB. Probability A given B is equal to probability of AB. AB divided by probability of B, given that probability of B is not 0. You can't divide anything by 0. The multiplication rule for probabilities in probability AB equals probability AB. A given B divided by probability of B. The probability of AB, A or B occurring, or both occurring, is denoted as probability A or B. The addition rule for probabilities in probability A or B is equal to probability A plus probability of B minus probability AB. The events are independent. When events are independent, the occurrence of one event does not affect the probability of occurrence of another event. Otherwise, the events are independent. The multiplication rule of independent events states that if A and B are independent events, probability AB equals probability A multiplied by probability of B. The rule generalizes in similar fashion to more than 2 events according to the total probability rule, S1, S2, all the way to Sn. The mutually exclusive or exhaustive scenarios of events, then probability of A equals probability of A, is equal to this chain. The expected values of random variables and the probability weighted average is the possible outcomes of the random variables. For a random variable of x, the expected value of x is denoted as probability of x. The total probability rule for expected returns states that probability of x is equal to each of this term of the sigma, the summation of these terms added together, where S1, S2, S2 all the way to Sn are mutually exclusive and exhaustive scenarios or events. So these are polynomial probabilities. The variance of random variables is the expected returns of the probability weighted average. The sequential deviation of the random variables expected value of the probability of E is equal to the variance of x equals this, where the variance of x squared stands for the variance of x. The problem of the variance of standard deviation. So remember, standard deviation squared is equal to variance. Variance is the measure of dispersion between the means. Increasing variance that indicates increasing dispersion. Variance is the measure of a squared unit of an original variable. Standard deviation is the positive square root of the variance. Standard deviation measures dispersion as does variance, but it measures in the same unit as the variable. Covariance is a measure of the co-movement between random variables. The covariance between two random variables, Ri and Rj, is fixed values of the cross product, the deviation of two random variables for their respective means. Covariance Rj is equal to this, the covariance of a random variable when itself it's its own variance. Covariance is a number between -1 and 1. The measure of a co-movement or the linear association between two variables are this. To calculate variance of a return on a portfolio of n assets, the input needed are n expected returns of the individual asset and variance of returns on an individual asset and n minus 1 divided by 2. Here's the return. The calculation of covariance in a forward-looking sense requires a specification of joint probability function, which gives Bell's formula.